Hello, well, thank you for joining. My name is Jamal Khan and I am a senior tax partner at Churchill Tax. We're expecting a very large crowd today. In fact, we're expecting around about 80 people on this session. We've got 50 have joined already. So we're expecting a large crowd of business owners, accountants, financial advisors, solicitors, and some barristers today. Let me just quickly, if I can just hit the record button. There we are. So we are recording. Right. Excellent. Okay. So more people have joined. So today's session is about trusts and tax planning. I will be taking you through main types of trusts, but rather than going into very much detail of what types of trust, because a trust can be, you can give any name to a trust, how they're taxed and what are the tax benefits. That's the purpose of this session. You can, I have seen people call many names to different types of trusts. So that's something that I would focus on. Right, so I'll just share my slides.
Active Walker.
Tom Love.
Tim Walker.
We've got an echo. I'm sorry. Should be. Oh. Okay. Let's see. I need to mute everyone. Yeah, I guess I need to mute everyone. And okay, let me just see if I can mute everybody because there is an echo. I'm assuming. Themselves. So if you can please mute yourselves, that would be greatly appreciated. Just to avoid echo in the room. I would really appreciate it because I'm getting messages that there is echo in the room. If you guys can still hear an echo, please do let me know and I will see what I can do. Okay, excellent. Right, let's get started. So I will share my screen. Here we are. And if I can click on the right. So here we are. As I said, today's session is about trusts and tax planning. I'm not going to go into different types of trusts because all trusts are now taxed as discretionary trusts. So we're just going to go through some different types of trusts that we come across on a regular basis, but then the purpose is to talk about the taxation of trusts. So this is a little bit about us in terms of what we do. We mainly specialize in tax planning for larger estates or people who have property portfolios or large portfolios of assets in the UK or outside of the UK, people coming into the UK, people going out of the UK. So that's what we specialize in. What is a trust? So just to kind of break it down, a trust is essentially a document that holds assets. It's created through a document, but it holds assets and managed by one or more people called the trustees for the benefit of beneficiaries. Okay, so this is a very kind of a simple definition of a trust, and it's governed by a trust deed. A trust deed has, if you've seen, it has a number of who's the settlor of the trust, who are the trustees of the trust, and then who are the beneficiaries of the trust. And then you've got guarantors and some other people, or people who are protectors of the trust. But you can add different types of kind of powers within the trust. Who's got the powers to appoint? Who's got the powers to remove trustees or add trustees and beneficiaries? But there are many different types of things that you can do with the trust. But that doesn't affect the taxation treatment. So our purpose of today is to look at the taxation. So a typical example of what you would normally see these days: a living trust, or an asset trust, or a family trust, or a will trust, or there's a lot of different things that you see. A will trust essentially means nothing in my view. But a living trust is somewhere, for example, it's not like a will, but you set out your wishes about the assets that about what happens to your assets that earn you heirs, and will is effective essentially when you die. But when you create a living trust, it's when the assets are put into a trust whilst you're alive, and they can be the benefit of those trusts can be passed, or those assets can be passed on to the beneficiaries whilst you're still alive. And you can create a letter of wishes, for example, of what happens when you die, and how the trustees should manage the assets, and how the beneficiaries would benefit, or would be receiving benefit from capital or income element of the assets held by the trust. So you can put as many assets into a trust. I mean, we call it living trust, but essentially these are all now treated as discretionary trusts. So the trustees take control of the assets as soon as they're appointed, and the original owner or the settlor no longer has control of the assets, because they're transferred into a trust. So there's more and more people joining. Sorry. Okay. Just go to the next. So the benefit of creating a trust is that it bypasses the time-consuming process of probate and assets that can be managed without need to wait for a grant of probate. The trustees, as I said, don't have to wait for the settlor to die for the assets to be passed on to the beneficiaries, or the benefit of the assets to be passed on to the beneficiaries. They can essentially transfer the assets during their lifetime. The trustees have the power to limit the access to the beneficiaries. So if the beneficiaries are, for example, I don't know, if the settlor wishes was that, for example, if beneficiaries are, I don't know, well behaving or going in accordance with their wishes, then it's then yeah, they can be entitled to receive benefit. However, if whatever happens, something goes wrong, some things go south, then the beneficiaries do not receive a benefit. Then we've got the trustees are essentially guarding the assets on behalf of the settlor, so for as long as the settlor is alive, and the settlor, once the settlor passes away, that they leave a letter of wishes. And once the children reach a certain age, the trust can be, for example, closed down, or the trust can be can continue indefinitely. There are different factors which we'll discuss later on presentation. Okay, essentially, so let's get back to the basics of how trusts are taxed. Right. So the rules for taxation of trusts changed some time ago. I mean, back in the days, trusts were very fashionable, and then the rules changed, and then Gordon Brown brought some more rules in back in 2004, 2006 time. So the government didn't like trusts, and the rules have been made so that people they're very prohibitive. So people would not be attracted to trusts as such. So now, under the new rules, if combined, the rules are when I say the new rules, the rules are that if you transferring properties into a trust worth more than £325,000 per set law, then an immediate tax charge of 20% is applied. This is called the lifetime charge, and if that set law then passes away within 7 years, between 7 and 10 years, then there is another 20% payable. So this is essentially half of your inheritance tax that's applicable on settling of the or creation of the trust if the value of the assets is more than £325,000.
I've got another one. He's not coming to 11 o'clock tomorrow. So
What happens essentially is for example, if you've got a client, or if you have properties in, say, the London area, where properties are quite expensive, then it's just not worthwhile creating a trust. And I'll come on to situations where you can create a trust. But otherwise, it's for example, if you're looking at properties in kind of remote parts of Scotland or Wales, or then yeah, you can put a couple of properties into a trust and not have to pay any lifetime tax charge or lifetime charge of 20%. But that's not it. So a lot of people that I come to me for advice, and I spoke to somebody yesterday who wanted to set up a trust. And I spoke to him about this, and I said, well, if he had assets worth about £2.5 million properties, well, if you do this, you'll have to pay almost for £400,000 or £500,000 in tax. And he said, no, that's not the right thing for me then. The next thing about trusts is there's a 6% charge applied to trusts every 10 years on the value of the trusts at that particular point. So this can be quite expensive. So I'll give an example. About 10 years ago, roughly, just under 10 years ago, a client approached me, a new client approached me, and he wanted to set up 2 trusts. And he had been talked into setting up a trust by some salespeople. I said to him, very bad idea, don't do it. It's because you've got properties in London, these properties going up in value. Anyway, he set up a trust. At that time, he had significant mortgages. So somehow the assets got into the trust between him and his wife. And there was no tax charge payable at that particular point. But then the assets grew in value. Now he's coming just to his 10-year anniversary charge. And his 10-year anniversary charge is going to be quite significant because the assets are worth about good 3-4, I would say about £6 million, because he's paid off most of the mortgages and assets have grown in value. Now that guy's panicking. What do I do now? Do I close down the trust? Because if you close down a trust, I mentioned there are exit charges. So it's you can't close down a trust just on the 10-year anniversary. Exit charges are calculated on a pro rata basis. So essentially, if you close down a quarter before the 10-year anniversary charge hits, it will be calculated proportionately. So there's no benefit in closing down a trust just before the 10-year anniversary. And this guy that I'm talking about, he had as soon as he set up the trust, his biggest problem that he faced at that time was the 45% income tax that was payable on the which is which is due in trust income. So there's no kind of threshold, minimum threshold. I think it's about £2,000, but this guy's income was in hundreds of thousands of pounds. So the minimum tax is 45%. That's applicable on the trust income, and you're not allowed many expenses to claim many expenses as a deduction. Yes, you can get credit for the beneficiaries who are at a lower rate. For example, if the income is distributed. What happens is, in reality, is that you have to pay the well, as the trust files its annual returns, tax returns, it has to pay the payment on account in January and in July, like all the others, and it has to pay at 45%. And the income is then distributed onto, if the income is fully distributed onto the beneficiaries, and say the beneficiaries are basic rate taxpayers, then somehow at a later point they get a tax rebate because they've paid too much tax on the trust income, or the trust has paid too much tax. But the process of that and the cash flow issues, especially if you've got a mortgage, it can cripple a company or a person, especially because you wouldn't have the money to pay the payment on account in January and then in July. So there are lots of problems. Now, this client that I'm talking about, he's coming to me and says, Jamal, I need to get out of this trust somehow. Please get me out of this trust. So something that to keep in mind is that if you are going into a trust, be very, very mindful of these issues. Now, some people call it an asset trust, some people call it a family trust, some people call it a I don't know, protection trust, the children's trust, a will trust. They're all the same. Okay, you can call it anything. You can call it, I don't know, bazooka trust, right? But it's all the same. Essentially, all taxed as discretionary trusts in the UK. Before, we had some different tax rates that were applicable many years ago, but then the government changed rules. This is all kind of when Gordon Brown wanted to simplify the whole taxation of trusts. So there is one or two different types of trusts, which I'll talk to you about later. But just so you're aware that most of the trusts are taxed as, even the foundations are taxed as trusts, discretionary trusts. So if somebody has a foundation, because we acted for a couple of foundations that were originally holding assets in Liechtenstein or BVI or Isle of Man, but then the UK recognizes them as discretionary trusts. Okay. Now, there's another concept called a deed of trust. So there's something called a deed of trust and a trust deed. Okay, very different documents. And I see people, I mean, I advise on this almost every day. When I say the deed of trust, people start assuming that means a trust. When I say trust deed, that is by default, that means it's actually a real trust. A deed of trust is not a real trust. Okay, it's so it's different to ordinary trusts. So in a deed of trust, assets are held on behalf or on trust for another person. So, for example, I say to my brother that can you hold a property for me because I'm not able to buy a property, or but I will retain all the beneficial rights. So, but on land registry, the property will be held by my brother. Okay. So the beneficial owner, I'm the beneficial owner, but my brother will become the legal owner. Okay, so on land registry, say one person will be the legal owner, but I will remain the beneficial owner. That means I will be subject to income tax. I will be subject to capital gains tax on sale of the property, or inheritance tax, say if I pass away. Okay, there is no requirement to register a deed of trust on land registry. So, for example, I could hold, as long as a deed of trust is a legal document, it's created by solicitors, or we can create, but so it has to be signed, it has to be witnessed. Okay, and normally when somebody files a tax return, it's you would say in your tax return that asset is held on trust for me by, for example, XY, Mr. whoever, but I'm the beneficial owner of this asset, and hence it's going. And rental income from this trust asset is going on my tax return. But it could be that, for example, there's no rental income, main residential property, but owned by somebody else. But as long as it's witnessed, sometimes people can register a deed of trust on land registry. There's no such requirement. Okay, it's ideal to protect assets so someone cannot purchase an asset in their own name. For example, I spoke to somebody yesterday who's whose family members are sending money from abroad, from the Middle East, around about £1 million, but they don't want to buy an asset in their name. They want the asset to buy it in the name of the person who's living in the UK. And my advice to them was, okay, well, why don't you use a deed of trust? And his question was, well, they'll trust them. I said, no, it's not a trust, it's a deed of trust. It's not a trust deed. And that's where the funny part is, that people confuse them as two, it's the same item, but they're very, very different. So deed of trust can be very useful. We use them quite a lot. And it's just simple tax planning, especially, for example, for main residences, or where parents can transfer a portion of their property to their children without having to make any changes on land registry. So it could be quite useful. Okay, the next one is bereaved minors trust. Now this is an important one, and it only comes into life at very unfortunate events. For example, a young person passes away, leaving behind minor children, right, under the age of 16. So you cannot have a bereaved minors trust for somebody older than the age of 16. So normally bereaved minors trust, when we advise clients, is we advise them to have this as part of their will. Right. So we have so for example, it'd go into people that come to us. We put a clause for having a bereaved minors trust in their will in case they have young children, and in case they die before the children reach the age of 16. So what happens in case somebody does reach the age of 16? Sorry, does die before the children reach the age of 16? The assets are transferred into a bereaved minors trust, which essentially means that once again, it's a document that holds it. The document that holds it, and it's something that the children, a death, the assets are transferred into a trust. There is no inheritance tax to pay. There's no capital gains tax to pay. Okay, so this is quite a big advantage. And when the children reach the age of 18, or we can go up to 21, the assets are transferred to the children from the trust. The trust has to be closed. It cannot continue onwards after the children reach the age of 21. Okay, so the assets are transferred back to the children from the trust. There is no capital gains tax to pay, and there's no inheritance tax to pay. So you've skipped the whole generation of inheritance tax and capital gains tax. So these can be quite useful. And there are some kind of benefits for the or income tax side as well. So bereaved minors trust, in my career, we've had to set them up. We set them up many times in the wills, but a few times I've seen them come into life because unfortunately my clients have passed away. One of them was a very successful young lady who had stage 4 cancer. And she came to me and said, well, I'm going to die soon. I've got 2 young children, aged 5 and 6. How do I protect them? And she had quite a few assets. And I advised her to set up a bereaved minors trust. And then we did that, and she passed away. But she wanted to make sure that, for example, her partner at that time does not put the assets somewhere else. So she appointed her mum and her sister, etc., as the trustees. So this could be a very useful tool. Next one is offshore and onshore trusts. So if you can look at the screen and you can see how many different types of variations there are but there's benefit onshore assets versus offshore assets, and then offshore trust for offshore assets. Anyway, I'll go through these individually. But the point is that people try to do every day almost. I hear people talk about, I want to set up an offshore trust. Okay, why? Because somebody said it's a good idea. Why do you think it's a good idea? And then I hear people say, well, I've got assets and I want to protect my assets. I'll go and set up a trust in Jersey. Now, this could have been a very valid point, or I don't know, Isle of Man or BVI, or well, it doesn't matter. This could have been a very good tax planning exercise back in the 1980s, 1990s, but it's not anymore. Okay, so if you've got assets in the UK and if you set up an offshore trust, the whole thing about the discretionary trust and how that still applies. Okay, the 10-year anniversary and the 20%. So now there is no benefit. And the way the legislation is drafted now since 2014 is that people are taxed regardless. If you put an asset into a trust, trust has to pay. Even if it's an offshore trust, it has to pay the 10-year anniversary charge. It has to pay the exit charges. It has to pay the income tax. So there is no essential benefit of having a trust. What people do is they would put properties into a limited company which is owned by a trust. Okay, but under the new rules, the government sees through that. So people will still have to. So now people that had set up trusts up until, for example, 2002, 2003, I am being instructed by many clients who had done that to help unwind those trusts or to bring those trusts onshore, because one problem is having them to manage an offshore trust, and secondly, the trustees or the nominee trust directors or the trustees of offshore trusts can be extremely expensive, and they essentially write themselves a blank check every year with respect. If one of the people in the crowd is in the audience today is an offshore nominee, but that can be very expensive. So I've seen some real horror stories, and then they want to let you go. So if you want to, for example, appoint a tax advisor, if the client appoints a tax advisor or somebody to bring the trust on shore, the nominees don't want to let go. Because it's a regular source of income for them. Okay, so let's talk about, so we've got onshore assets and offshore assets. So yes, you can set up if it's, we've got one client who's coming from Malaysia, and they've got some offshore assets, and they also have some onshore assets. They're coming to the UK. So as part of the planning, what we did was to set up an offshore trust for offshore assets. Okay, and do not set up a trust for UK assets. An offshore trust is managed by offshore trustees, so that they're never subject to tax in the UK, because these people will eventually become taxable, subject to inheritance tax in the UK, or income tax, for example. But if it's an offshore trust with offshore trustees, then those assets will never be subject to UK tax. Okay, so that could be quite a clever planning. But if it's an onshore trust, then you don't need to worry about an offshore trust. Okay. Offshore trust for offshore assets, yeah, that's a good something that you could do. Onshore trust for onshore assets, yeah, once again, that's not such a good idea. Okay, and that's it for me. It's going to be half an hour session. I think I've gone over a little bit. If you've got any questions, if you've got any concerns, if you want to discuss a situation about somebody or one of yourself or one of your clients, you can give me a call. My secretary will send you the slides. She will probably send you the recording link as well.